So the infrastructure fund was established 15 years ago. So a good long-term track record, working through various market conditions. What we've tried to do with the listed infrastructure fund is find a combination of income, inflation protection, and structural growth through the cycle. Tends to be invested in regulated contracted businesses. You might see half the fund in, say, regulated utilities, electric utilities, and the other half in a combination of transport, so roads, airports, railroads, and then pipelines, LNG terminals, mobile towers, data centres, which give you a nice mix of capital-intensive essential services, that are provided to consumers. Actively managed strategy, very much bottom-up stock pickers, investing in things that I think are reasonably easy for everybody to understand. So let's go through those components around income, inflation protection, and structural growth, and what are some of the drivers. We think in that combination, you can get 3 to 4% dividend yield, plus 5 to 6% growth through the cycle for an 8 to 10% total return. So first of all, talking about income, we're certainly of the view, and I think this is a view shared by the previous speaker, that income is not only about getting a good upfront yield, it's also about the growth and the sustainability of that income over time. One of the pleasing things about infrastructure is, by nature, these are regulated, contracted businesses, often in privileged positions, within their markets, monopoly, duopoly type market structures, and that can lead to a very stable income through time. We saw that through the financial crisis 2007-8, and we've obviously seen it more recently through COVID. Now, COVID had very direct impacts on things like toll roads and airports, as a result of the lockdowns. But bulk of the portfolio, utilities, towers, continue to sail through that COVID impact and continue to deliver very strong income to investors. You can see that there, comparing the infrastructure sector to broader UK equities. I think on top of that stability of income, what we look for over the medium to long term is a consistent growth in income. And we'll talk about some of the drivers of that growth with some examples. But for me, it's about solving problems. The world has a series of structural issues that they need to deal with, and investment, capital investment, is often the solution for everything from urban congestion to renewable energy and the move towards net zero, decarbonisation, to the mobility of communication and a world of 5G and cloud-based data. An example of some of that structural growth coming through in the type of regulated contracted business models that we like to invest in is the wireless tower industry. Companies like American Tower, Crown Castle, SCA, with 15-year, long-term contracts, built-in price escalators, a sort of three-player market. What they've been able to deliver consistently over time, all the way through various crises, is a stability of cash flow and a growth in cash flow. As you can see there, 12, 13, 16% compound growth in cash flows per share, and clearly, that adds up to a strong income over time. So the topic of the moment is obviously inflation, and we talk about infrastructure as a sector able to provide an inflation hedge to a portfolio, and clearly with inflation pushing up to 6-8%, in countries around the world, while we've theoretically talked about the potential for infrastructure to recover inflation, what's great in the last few quarters is we've been able to actually show that in practice. So here's two working examples, both long-term and more recently, and their ability to recover that inflationary pressure. The chart on the left is CSX, which is a east coast of the US freight railroad company, carrying basically the US economy on its back. Everything from agricultural products to coal and oil, to goods going to Walmart and Amazon in containers, automobiles, a whole range of industrial and consumer products that are carried on railroads. For the railroads, it's generally a duopoly market structure. And what we've seen from CSX is, and other railroads, is the ability to increase prices at or above inflation consistently through time. On top of that, they're able to pass through diesel fuel costs, which is the main input cost to their locomotives, and they're able to pass that through to the customer through the contract agreements. In the first quarter of this year, CSX was able to put through a 14% increase in revenue per carload as a result of those contracts and the pricing power that they have in their business. So, better than inflation recovery already coming through in the freight railroad sector. On the right is Republic Services, a waste management company in the US. The collection, transfer of waste, generally about 70% of that waste will go into landfill, maybe 30% going to recycling activities. And obviously we'd like to see more of that recycling going forward. The way the contracts work, a contract with a municipal, a corporate customer, industrial customer, contracts generally linked to inflation. So with a bit of a lag or a delay, the ability to increase prices in line with the inflation that we've seen over the last 6 to 12 months. On top of that, the pass-through of diesel fuel costs, used in their collection vehicles. And on top of that, that recycling activity that they do, the output from that recycling, whether it's glass or cardboard or steel, they can share in the benefit of that output with their customers. And so from an effective point of view, we've seen more than 6% effective price increases coming through in those waste management companies in the last quarter. And we expect that to accelerate through to 7-8% in the coming quarters as that inflation lag pushes through. So real evidence of inflation recovery within the infrastructure space. Of course, what's interesting is what's causing that inflation. We know there's tightness in many markets around the world, and we also know that through the Russia-Ukraine crisis, there's an energy crisis which is pushing up those key energy inputs. I want to also mention some of the areas we invest in, like LNG terminals, a company called Sentier, Sempra in the US, some of the world's biggest LNG export terminals that are bringing relatively cheap US natural gas and exporting that in liquefied basis through to the rest of the world. Now, historically, those volumes were going to Asia, China, Japan, Korea, but with the Russia-Ukraine crisis, where 40% of Europe's gas is coming or was coming from Russia, replacing that by diverting LNG towards Europe is helping solve this current crisis over here. As a result of being part of the solution, Sentier has been able to double its earnings over the last 2 or so years, building new LNG trains or large refrigerators, running those trains more efficiently. And for that component of their business that is currently uncontracted, sort of 10-15% of their business that's just recently opened, being able to sell that extra capacity into current spot markets at a very significant premium to solve a problem and earn significant return on the back of that. While LNG and gas is a short-term solution to the current crisis, ultimately what we need is a significant build-out of renewable energy, and that's where our utilities come into the equation. We all know that in the move to decarbonise towards net zero by 2050, that shift towards renewable energy has and will continue to happen. But I guess Russia, Ukraine has highlighted, and maybe China, Taiwan in the future has highlighted that geopolitics does impact energy markets, and security of energy supply will be critical going forward. To secure energy, that shift towards domestic sources of renewables will be key going forward, and that will only accelerate post recent events. We think the main beneficiary of that will be solar. Solar has now become, in many parts of the world, particularly with a strong solar resource, the cheapest source of energy, compared to wind, compared to gas and coal and nuclear before that. So that shift to solar is absolutely happening. When we co-locate that solar with batteries, it improves the capacity utilisation of that project and improves the economics, particularly when supported with government tax credits in the US and in Europe and elsewhere. Now, it's not without challenges. Current supply chain issues around solar panels, is a challenge, and we have seen a little bit of a push out in that growth. But as a long-term investor, as we are, and I think most of our investors in the fund also are, that growth is inevitable. Whether it happens, 6, 9, months later than expected, it will come through because we know how important it is to achieve that growth. Another layer of growth that we expect to happen beyond renewables is the shift to electric vehicles. Electric vehicles are happening, and the number of offerings and the quality of those offerings is expanding around the world. For every, say, 10 electric vehicles that are sold, we're going to need at least one charging station and charging infrastructure to be put in place. That relationship is very clear. It does vary by country and depends on the amount of urbanisation, but we're going to need a lot more charging stations around the world. We think utilities are best placed to roll out those charging stations, get a consistency of product offered, and we note that 80% of the full cost of rolling out a charging station sits with the electric distribution network. So regardless of who rolls out that charging station, it's the electric distribution network that will be the main capital investors and the main beneficiaries of that. Some countries, some states have been smart, and they've, I guess, allowed the regulated utility to do that rollout in a more considered, sensible way. And companies like Xcel Energy in the US, are planning to spend billions of dollars in a regulated framework which de-risks that capital investment on behalf of all of the consumers in those countries. Moving to some other sectors beyond renewables, where else are we seeing structural growth? As I mentioned earlier, the freight railroads, have been a clear beneficiary of growth over time. While there is an economic sensitivity that does flow through some of the volumes in the short term, what we know in the medium to long term is railroads have never been about volumes. Railroads are about delivering a consistent level of volume, but doing that much more efficiently over time. And we've seen over long periods of time, while volumes have been very stable, like carloads offered around the US network, the ability in a duopoly market structure to increase price, the ability to operate all of that more efficiently through technology, and then with that efficiency, the free cash flow that's generated from those companies, then allowing 4 or 5% buybacks of shares on issue, what we've seen is an old industry in many ways still delivering compound earnings growth, some 14-15% over time. So sometimes boring industries, as Buffett would say with his investment in Burlington Northern, some of the old industries can still deliver very consistent growth over time. What's important is that when you deliver that operating efficiency, it also comes with some side benefits. It's better for the customer, and it's also better for the environment as we shift from, say, trucks to railroads, much more environmentally friendly, much lower carbon intensity. And as the railroads improve their efficiency, they're also looking to reduce that carbon impact over time. So good for the customer, good for the environment, and good for us and you as investors. Another sector that's topical is the transport infrastructure space, and the strongest positive position we have in the portfolio is the toll road sector. We're very confident about the recovery in toll road volumes. I don't know if you've seen here in London, the pickup in traffic, but pretty much in every city in the world now, we're seeing traffic towards or above 100% of 2019 levels. We're seeing a preference or a market share shift from public transport to private vehicles. That was a thesis we had over the last couple of years, and great to see that play out in many parts of the world. Truck traffic, tradespeople, construction continues to be very solid in all cities, and that private vehicle traffic is also recovering very well. Also, as airports become more utilised, typically the toll road traffic that's going towards airports is more that domestic and leisure travel, where they're driving to the airport, and we're seeing a good recovery in that that type of travel as well. In the airport sector, we're very focused on leisure travel rather than long-haul business travel within the portfolio. I think that'll be the first to recover. The other thing I'd point out on toll roads is if there's any sector that has a direct correlation with inflation, it's toll roads. Basically, next quarter's price increase is last quarter's CPI print. So that direct flow through of inflation is one of the key reasons we're positioned in that sector as well. So just to wrap up, valuations, of course, okay, there's income there, there's inflation protection, there's a good structural growth story, but one of the key risks you take with any investment is the price you pay up front. Infrastructure, returns have been good over the last couple of years, and they've been exceptional in the last few months, holding up in a down market. But overall, we still think valuations look very reasonable. PEs, price to book, EBITDA multiples, yields are all pretty consistent with long-term averages. And as we look at a sector by sector level, we see pretty fair returns across most subsectors, and even cheap valuations in things like toll roads, and more recently in the tower sector. So that's encouraging for future returns. So I'll leave it at that. Infrastructure, I think, has delivered quite consistent returns through time, generally protected returns in down markets, and we've seen that particularly play out in the last few months. So hopefully, if you're an existing investor, you've been pleased with that outcome. And while we might not keep up with strongly rising markets, that preservation of capital in down markets we think is certainly very important. So thank you for taking the time today, and we certainly welcome any questions for all the panelists for now. Thank you.